The invasion of Ukraine naturally has markets on edge and raises questions about the impacts here and around the world. Our updated thoughts on the outlook and the implications for interest rates. The tragic human toll in Ukraine is of course the primary concern, and our thoughts are with those caught in the conflict. But beyond Europe, the markets are trying to get a sense of the impact of the invasion on energy and commodity prices, on supply chain constraints, and on confidence and demand. The sanctions announced this week, including removing a range of Russian banks from access to SWIFT, have initially seen a 24% fall in the value of the Russian ruble, and Russia's central bank has doubled interest rates to 20%. So, questions around default risk on this sovereign debt have the markets considering the extent of Russian exposures by global investors. The sanctions so far have centred on financial and technological exclusions, but not on energy exports. However, the price of oil is still elevated and volatile. It's through oil and other energy prices that the impact on economies around the world will be most tangible. So, for major advanced economies, the likelihood that energy prices will remain higher for longer means inflationary pressures becoming more persistent. Similarly, a range of commodities, including some agricultural and metal commodity prices, are likely to remain firm, which should help with Australian exports and may see our inflation rate continue to surprise the RBA on the upside. The geopolitical instability clearly is a driver of uncertainty across the board. However, given it's expected to add to inflation, and given our limited trade relationship with the region, the invasion is not expected to defer the first RBA rate hike later this year, which we still expect around August, after 2 more reads on the Consumer Price Index. Despite Delta and Omicron disruptions, and in advance of consumer confidence being tested by events overseas and our own weather-related tragedies currently unfolding, household demand, seen via retail activity, has remained as resilient as ever, up 6.5% year-on-year and around 17% above pre-pandemic levels. Retail sales were up in each state and territory. So, with our international borders reopened and a range of pandemic restrictions eased, the outlook is still positive, which should ultimately feed into a further 5% of GDP growth this year, on top of the strong read for 2021 GDP released today. Growth should be further supported by tight labour markets, a very healthy pipeline of infrastructure projects around the country, and more stimulus expected in the early federal budget on March 29th. But with the challenge of rising interest rates the primary headwind. The Aussie dollar will be a good barometer of this progress, including weighing up the downside risks on sentiment from the war in Ukraine and rising energy prices. But while volatility on the market seems inevitable, for Australia, we may see a lower peak in official interest rates once the RBA start their path to a more neutral cash rate than the market is currently projecting. So, assuming no escalation of the war outside of Ukraine and no lasting impact on global energy supply, central banks around the world are still expected to continue to steadily lift interest rates back towards more neutral settings, including the Bank of Canada this week and the US Federal Reserve later in March. And lastly, Australian property prices continue to rise in February, up 0.6% for the month and 1.6% in regional Australia. But Sydney prices ease back 0.1%, perhaps a sign that rate hikes later in the year will see much more modest increases for the rest of 2022 and perhaps modest falls in 2023. And that's the market update from Leveraged.